Welcome back to the club. The market is humming about Figma, and half of YouTube is singing along. We will cut through that noise in 8 tight moves. Each move is spoken, each move is clear. By the end, you will know whether this stock deserves a spot beside your pillow for the next decade. Figma feels like Google Docs for interface design. People edit the same screen at the same time, inside any modern browser. Figma Design handles precise mockups. FigJam opens limitless whiteboards for sticky note chaos. Dev mode turns pixels into copy-paste code for engineers. Slides converts designs into polished decks. Site spins those same assets into bite-sized web pages. Everything happens in one tab. One link invites the entire team. 13 million users sign in every month, and 2/3 of them are not designers. That broad reach creates a powerful network effect that rivals envy. Here are the competitors and how they compare. Adobe XD lives inside Creative Cloud and owns deep illustration power, but it lacks viral sharing. Sketch runs only on Mac computers, so Windows teams look elsewhere. Canva offers lightning-fast templates, yet its collaboration is light for professional product teams. Penpot is open source and costs nothing, but support is thin. Miro and LucidSpark rule the standalone whiteboard corner, yet they stop at brainstorming. Figma wins with real-time, multiplayer editing, cross-platform access, and an exploding plugin store. Figma trails in fully offline work, in ultra-heavy illustration detail, and in pure price against open-source tools. Features and rivals set the scene. Money is the frame around that picture. So now, the numbers get the mic. Last year, Figma booked $749 million of revenue, growing 48%. Annual recurring revenue already stands at $912 million, growing 46%. Net dollar retention lands at 132%, which means existing teams spend 32% more each year. Gross dollar retention is 96%, so only 4% of revenue walks away. 450,000 organizations pay today, and 1,031 of them each spend at least $100,000 a year. Gross margin is 88%. GAAP operating margin just hit 17%. Free cash flow margin sits near 25%. Add growth and free cash flow together, and the Rule of 40 score tops 70. Sales efficiency equals 1, so every dollar in sales and marketing produces $1 of new gross profit within 12 months. The metrics sparkle, yet liquidity steadies nerves. Let's see how Figma found a $1 billion cushion that most startups only dream about. In September 2022, Adobe offered $20 billion to buy Figma. Regulators around the world frowned at that much design power under one roof. After 15 months of scrutiny, Adobe dropped the deal in December 2023. A termination clause forced Adobe to wire Figma $1 billion in cash. That single wire raised Figma's cash position to $1.5 billion. The cushion lowers bankruptcy risk, funds new products without fresh debt, and supports global hiring. The fee produced a one-time profit spike in 2023, but even after removing the spike, Figma reported GAAP profit in the first quarter of 2025. Cash brings comfort, yet sustained growth demands an engine. Time to open the hood on that engine. Every journey on Figma starts with a free tier, and free removes friction. One designer sends a URL, a coworker clicks that link, edits instantly, and becomes the next silent marketer. Word of mouth outpaces paid ads, so acquisition cost sinks towards 0. The S1 filing shows sales efficiency of 1, confirming that point. Annual cloud spend, mainly on Amazon Web Services, is $109 million, roughly 12% of revenue. 88 cents of every revenue dollar survive after paying that bill. Free users upgrade to paid plans. Paid seats then expand across the organization. Security controls and admin dashboards push the price per seat higher. That land and expand motion locks net dollar retention at 132%. Low acquisition cost meets high expansion, so free cash flow already equals 1/4 of revenue. That cash bankrolls slides, bankrolls sites, and bankrolls whatever comes next, which attracts more teams who invite more coworkers, repeating the flywheel. The engine explains momentum, but resilience comes from history. A quick story shows how Figma handled storms on its way here. In 2013, a 20-year-old Dylan Field stood in a Brown University dorm room. He chose a $100,000 Teal Fellowship over finishing class, convinced that design belonged in the browser. 3 years later, in 2016, a tiny team shipped the first public preview. Designers opened Chrome, dragged rectangles together, and gasped on Twitter that real-time design had finally arrived. By 2019, Figma released Community, turning one-off files into remixable templates. Templates spread like popular songs on a playlist, tightening network effects overnight. March 2020 changed everything. Office doors closed, and remote work became mandatory. Figma's browser-first model turned from nice to have into vital infrastructure, and usage tripled in a single quarter. The summer of 2021 brought a funding round that valued the company at $10 billion. Figma felt tall, but knew the mountain stretched higher. Autumn 2022 delivered Adobe's $20 billion proposal. Regulators hesitated. A year later, in December 2023, the proposal died, but the $1 billion termination payment hit Figma's bank account. June 2025 saw the release of slides and sites at the annual Config conference, instantly doubling Figma's addressable market. Just weeks later, the first quarter filing revealed a revenue run rate above $900 million and GAAP profit for the first time. 12 years have passed since that dorm room decision. Those years show patience, adaptability, and compounding in action. Patience matters, yet Wall Street still asks, at what price? Now we weigh that price. The midpoint of the IPO range is $26.50 per share, which gives Figma an enterprise value of $16.4 billion. That means investors would pay 22 times the last 12 months of sales, or 18 times current annual recurring revenue. For comparison, Adobe shares trade near 7 times sales. Atlassian trades around 10. Private market Canva hovers at 18. Figma clearly commands a premium. Premiums can reward holders or punish them. To see which way the scale tilts, we have to lay out the risk terrain. Rising interest rates can compress valuation multiples. AI-powered design tools sprout weekly and fight for attention. Figma's balance sheet holds roughly $70 million in a Bitcoin ETF, and management plans to buy $30 million more, adding volatility. An AWS contract obligates $545 million over 5 years, so cloud cost discipline cannot slip. Premium price, hungry rivals, and a crypto-flavored treasury form real risks. Risk calls for a steady plan. That plan closes the show. Pick a drawdown limit you can live with. Many ambitious long-term investors, including me, choose 40%. Begin with 1 to 2% of total assets, add shares slowly, on a preset schedule, not on opening day emotion. Write a 5-year thesis on paper and promise not to rewrite it in panic. If that thesis breaks, exit calmly. No panic, no regret, only disciplined process. Numbers cut noise and patience turns numbers into peace. Figma offers speed, reach, and margin, but it charges a premium for that privilege. Plant the sapling only if you accept both truths. Water it with time instead of worry, and compounding will work while you sleep. If tonight's breakdown helped you see how valuation, growth, and hype can coexist in one ticker, you'll appreciate a parallel lesson. Tap the video appearing in the upper right corner. It takes you to Meta's AI bet could change everything, or collapse first. That episode shows how another headline-grabbing company is balancing giant growth ambitions against an equally giant price tag. If this video was helpful, please click like, hit subscribe, and share the channel with a friend who worries about markets more than they'd like to admit. Thank you for watching, and I'll see you in the next one.